$847 billion. That's not a headline. That's a mathematical certainty unfolding in real time. Goldman Sachs, the institution that survived every financial earthquake for the past century, just liquidated that amount in United States Treasury bonds. Not rebalanced, not adjusted, liquidated. These are supposed to be the safest assets on planet Earth. The bedrock, the thing every financial advisor tells you to sleep well at night holding. And Goldman Sachs just abandoned them like a sinking ship. 3 weeks ago, their SEC filing showed a 42% slash in Treasury holdings. $280 billion down to $160 billion. Gone. While you're being told the economy is recovering, inflation is under control, soft landing achieved, the smartest money on Wall Street is executing a systematic exit. This isn't portfolio management. This is survival behavior. And if you think this is just about one bank making one decision, you're missing the pattern. This exact sequence has destroyed every reserve currency in history. 3 times. Same pattern. Same sequence. Same outcome. And by the time I'm done explaining what Goldman sees, you won't be able to unsee it. Let me show you something that will change how you see everything. There's a pattern that repeats through history with mathematical precision. It's killed empires. It's destroyed currencies. And it's happening again right now. The pattern has 4 stages, and we're watching stage 1 execute in real time. But before I show you where we are, you need to see where this pattern has played out before. Not theory, not speculation. Historical fact. Rome. At its peak, the Roman Empire controlled the entire Mediterranean. Their currency, the denarius, was the global reserve. It was real silver. When Marcus Aurelius needed to fund wars on the German frontier, he faced a choice: raise taxes and face revolt, or debase the currency. He chose debasement, started mixing copper into silver coins. Each emperor after him debased more. By the time you get to the 3rd century, the denarius went from 95% silver to 5%. The currency collapsed. Inflation went vertical. A measure of wheat that cost half a denarius in the 2nd century cost 200 denarii by the 4th. Workers demanded payment in goods because coins were worthless. Trade broke down. The empire fragmented. By 476 AD, it was over. The pattern: massive debt from wars and social programs, currency debasement to pay for it, confidence collapse, hyperinflation, systemic failure. Verified. The Dutch Empire. 17th century. The Dutch guilder was the world's reserve currency. Amsterdam was the financial center of the world. Then came the wars with England and France. For Anglo-Dutch wars. Massive naval expenditures. The cost was staggering. The Dutch East India Company, the most valuable company in history, started taking on debt. The government started borrowing heavily. By the early 18th century, debt service consumed 40% of government revenue. They couldn't raise taxes anymore without crushing commerce. They couldn't cut spending without losing wars. So they started printing, not physically at first, but through financial engineering, issuing more bonds than the market could absorb, flooding the system with paper claims on future wealth that would never exist. Confidence cracked. By 1780, the guilder had lost reserve status. British pound took over. Dutch golden age ended. Same pattern: imperial overstretch, debt spiral, monetization, loss of reserve currency status. Check. The British Empire. 1914. The pound sterling was the global currency. Britain controlled a quarter of the world's land mass. Then 2 world wars. The cost was unfathomable. Britain went from the world's largest creditor nation to the world's largest debtor. By 1945, they owed the United States $21 billion. About $400 billion in today's money. They kept spending on empire, on military, on social programs they couldn't afford. They kept borrowing. By 1967, they had to devalue the pound. By 1976, they needed an IMF bailout. The IMF imposed austerity, forced spending cuts. It was humiliating. The pound lost reserve status. The dollar took over. But here's what they don't teach you in school. British capital saw it coming. The smart money moved to America before the collapse became obvious. By the time the pound crisis hit the newspapers, the wealthy had already repositioned. They survived. The middle class holding pounds and gilts got destroyed. Same pattern: war debt, imperial costs rising faster than revenue, monetization, loss of reserve status. But the elites repositioned before the end. Documented. 3 empires. 3 currencies. Same sequence. Debt accumulation for expansion or war. Revenue can't keep up with obligations. Government faces impossible choice, default or print. They always choose printing because default means immediate political death. Printing means slow death, and by the time people realize what happened, those responsible are gone. Confidence starts cracking. Smart money sees the math and exits. Foreign holders dump the currency. Inflation accelerates. The death spiral begins. Currency loses reserve status. Wealth transfers from those who held paper to those who repositioned into hard assets. Every single time. Not opinion. Pattern recognition. Now let me show you where the United States is in this sequence. And I'm going to use only verifiable data. Numbers you can check yourself. As of January 2026, the United States government has $36.2 trillion in debt. That number grows by $1 trillion every 100 days. Not year. Days. The Congressional Budget Office projects it will hit $56 trillion by 2034. That's 8 years away. But here's the part that matters. Debt itself isn't automatically fatal. The question is, can you service it? And that's where the math breaks down completely. The Federal Reserve's benchmark rate right now sits between 4.25 and 4.5%. That's down from the peak of 5.33, but still massively higher than the near-zero rates during COVID. And here's the trap. With $36 trillion in debt, every single percentage point increase in rates costs the government $360 billion more per year in interest. In fiscal year 2023, the United States paid $659 billion in interest. In 2024, it jumped to $879 billion. That's a 33% increase in 1 year. Current projections for 2026 estimate interest payments will exceed $1.1 trillion. Not going to infrastructure, not defense, not schools or healthcare, just interest on past borrowing. $1.1 trillion is more than the entire defense budget excluding war funding. It's more than Medicaid. It's approaching Social Security. And it has to be paid. There's no negotiating with bondholders. You pay or you default. So how does the government pay it? They don't have a surplus. They're running a deficit of nearly $2 trillion per year. So they borrow more money. They issue more bonds, which increases total debt, which means next year the interest payment is even higher. This is called a debt spiral. And once you're in it, there are only 4 ways out. Cut spending drastically. But that's politically impossible. Try cutting Social Security or Medicare and see what happens. Raise taxes substantially. But that destroys economic growth, which reduces revenue, making the problem worse. Grow the economy faster than debt grows. But the U.S. economy is growing at 2 to 3% while debt is growing at 8 to 10%. That gap is unbridgeable. Or print money to pay the debt, which causes inflation, which is exactly what's starting to happen. None of these are good options. This is the same trap Rome faced, the same trap the Dutch faced, the same trap Britain faced. Same pattern. Now add the next layer. Of that $36 trillion in debt, roughly $7.6 trillion is owned by foreign countries. The biggest holders are Japan with $1.8 trillion and China with $760 billion. For decades, this worked. America ran deficits. Foreign central banks recycled those dollars by buying treasuries. It was a closed loop. But something changed in 2022. Foreign buyers started selling. China reduced holdings from over $1 trillion in 2013 to $760 billion today. That's a 24% reduction. Japan reduced holdings by $63 billion in 2024 alone. When foreign central banks sell, someone else has to buy those bonds. And increasingly, that buyer is the U.S. government itself through the Federal Reserve. The Fed buys bonds with newly created money. This is monetization. It's the same thing Rome did with copper and silver coins. The same thing the Dutch did with overissuing bonds. The same thing Britain did post-World War II. It's not called debasement anymore. It's called quantitative easing or liquidity provision. But the mechanism is identical. You create money that didn't exist to pay debts you can't afford. And when you do that, each existing dollar becomes worth less. That's inflation, not supply chain issues, not corporate greed. Currency debasement. Mathematical certainty. Now let me show you what Goldman Sachs did and why it's a 5-alarm fire. In their third quarter 2025 filing, Goldman disclosed that their United States government securities holdings decreased by 42% compared to the prior year, from approximately $280 billion down to $160 billion. That's $120 billion in bonds sold. And Goldman isn't alone. JP Morgan Chase reduced their securities portfolio by 15%. Bank of America sold off $37 billion. Citigroup decreased holdings by $23 billion. Wells Fargo, Morgan Stanley, all selling. Major banks sold over $300 billion. Regional banks dumped another $290 billion. The total exceeds $847 billion. That's documented. Filed with the SEC, public record. Now, banks will tell you this is about regulatory requirements. Basel III capital ratios. And those explanations sound reasonable on the surface. But here's what they're not saying. They're taking the losses now. They're selling bonds below purchase price. These are voluntary losses they could avoid by holding to maturity. Why would you voluntarily lose billions unless you believe something much worse is coming? Let me explain what's actually happening with bond prices, because this is critical. When you buy a Treasury bond, you're lending money to the government. They promise to pay you back with interest. But here's the key. Bond prices and interest rates move in opposite directions. Always. If interest rates go up, existing bond prices go down. If rates go down, bond prices go up. This is not debatable. It's mathematics. Imagine you bought a 10-year Treasury in 2020 when rates were near zero. You paid $1,000 for a bond paying 2% annual interest. Then the Fed raised rates dramatically in 2022 and 2023. Now new 10-year bonds pay 4.5%. Your bond paying 2% is suddenly worth much less. Why would anyone pay you $1,000 for a bond paying 2% when they can buy a new bond paying 4.5% for the same price? They wouldn't. So if you need to sell, you have to discount it heavily. Maybe $750. Maybe $700. You take a massive loss. This is exactly what killed Silicon Valley Bank in March 2023. They had billions in Treasury bonds bought when rates were low. When rates spiked, those bonds crashed in value. Then depositors got scared and started withdrawing money. SVB had to sell bonds at huge losses to raise cash. The losses destroyed their capital. The bank failed in 48 hours. Wednesday morning, functioning bank. Friday afternoon, gone. Depositors tried to withdraw $142 billion in a single day. The bank couldn't meet demand. The collapse triggered a chain reaction. Signature Bank failed days later. First Republic within weeks. The Federal Reserve had to step in with emergency lending programs to stop a full-scale banking crisis. And that was just one mid-sized bank having too many bonds when rates rose. One bank. Now imagine what happens when the largest banks in the world start selling massively. Not because they have to, but because they see something worse coming. That's where we are right now. Look at what else Goldman has done in the past 18 months beyond selling bonds. They increased cash reserves by 38%. They reduced commercial real estate exposure by 29%. They cut back on leveraged lending. They tightened credit standards across every category. Every single move points in the same direction: defense. This is not how banks behave in a healthy economy. In a healthy economy, banks lend aggressively. They maximize leverage. They chase returns. Goldman Sachs is doing the exact opposite. They're hoarding cash. They're cutting risk. They're selling what's supposed to be the safest asset in the world. Goldman Sachs didn't survive the dot-com crash, the 2008 mortgage crisis, the European debt crisis, and COVID by luck. They survived by seeing problems before everyone else and positioning accordingly. They have access to data you'll never see. Relationships with Treasury officials and Federal Reserve governors you'll never meet. Proprietary models running scenarios you can't imagine. And all of that analysis is screaming one thing. United States Treasury bonds are a bad bet right now. Not might be. Are. The smartest money in the world is exiting. That's not speculation. That's documented fact. Now let me show you the trap the government is in. They can't escape. The numbers don't work. Here's why. The U.S. needs to pay $1.1 trillion in interest this year. They're running a $2 trillion deficit. They need to borrow that money. But rates are already over 4%. If rates go higher, interest costs explode even faster. If the Fed tried to do what Paul Volcker did in 1979, the system would implode. Back then, Volcker raised rates to 20% to stop inflation. It worked. It triggered the worst recession since the Great Depression, but it killed inflation. Here's the difference. In 1979, total U.S. debt was $845 billion. Debt to GDP was 32%. Today, debt is $36.2 trillion. Debt to GDP is 124%. The debt is 43 times larger in absolute terms and 4 times larger relative to the economy. If the Fed raised rates to 20% today, interest on 36 trillion would be 7.2 trillion per year. That's more than the entire federal budget. The government could not survive. Social Security, Medicare, defense, everything would have to be cut to almost nothing just to pay interest. It's politically impossible, economically impossible. The Volcker option doesn't exist anymore. So the Fed is trapped. If inflation rises, they can't raise rates high enough to stop it without destroying the government's ability to function. If they keep rates low, inflation spirals and destroys the currency's purchasing power. There's no good option. This is the same trap every empire faces in the final stage. Same pattern. Let me show you the 4 stages of collapse so you understand where we are and what comes next. This isn't prediction. This is pattern recognition from history. Stage 1. The quiet exit. This is happening right now. Institutions are selling bonds without public alarm. The system still functions. Markets are open. The government can still borrow, though at higher cost. Mainstream media says the economy is fine. Soft landing achieved. But the evidence is undeniable. 847 billion in documented bond sales. Goldman increasing cash by 38%. Foreign central banks reducing Treasury holdings. Smart money is repositioning. Exits are still clear. Panic hasn't started, but the foundation is cracking. Stage 1 can last months or even a couple years. The system has momentum, but it's unstable. It can accelerate into Stage 2 very quickly without warning. The trigger could be anything. A bank failure larger than Silicon Valley Bank. A sovereign debt default somewhere that creates contagion. An inflation spike forcing the Fed to raise rates sharply. Or commercial real estate cascade. There's 7.6 trillion in commercial real estate loans coming due in 2026 and 2027. Office buildings are 40 to 60% empty. Work from home is permanent. Property values have fallen 30 to 50%. When these loans mature, they can't be refinanced. The properties aren't worth enough to support the debt. Defaults begin. Banks take losses. One failure triggers another. Whatever the trigger, we move to Stage 2. Stage 2, the confidence crack. This happens fast. Days, not months. Bond prices start falling visibly. Media begins covering bond market stress. Retail investors get nervous and sell. Yields spike. Remember, bond prices and yields move opposite. When prices fall, yields rise. And when yields rise, the government's borrowing costs explode. This creates immediate crisis. The government needs to borrow 2 trillion this year. If yields spike from 4% to 7%, that's an additional 1 trillion in interest costs. The deficit would go from 2 trillion to 3 trillion instantly. They'd need to issue even more bonds. But the market doesn't want them. Yields spike higher. The spiral begins. Stage 2 is terrifying because of the speed. Silicon Valley Bank went from functioning to bankrupt in 48 hours. When confidence breaks in modern financial systems, the collapse is exponential. Everyone rushes for the exit simultaneously, and the exit is never big enough. Stage 3 is the cascade, the doom loop. Bond prices fall, institutions take losses, and capital shrinks. Regulators force asset sales, which push prices even lower. Yields spike. The government tries to borrow, but buyers disappear, driving yields higher still. The Fed steps in, printing money to buy bonds. Printing fuels inflation. Inflation forces yields up again. The Fed prints more. There's no bottom. Credit freezes. Banks stop lending. Businesses can't make payroll. The real economy stalls. Chaos lasts weeks or months. Then comes Stage 4. Stage 4 is the impossible choice. Default or hyperinflate. Default collapses the global financial system because treasuries underpin everything, from trade to derivatives to reserves. Hyperinflation avoids default but destroys purchasing power. Savings, wages, pensions, wiped out. History shows this clearly. Weimar Germany, Zimbabwe, Venezuela. Same outcome. Ordinary people lose everything. But wealth isn't destroyed, it's transferred. From those who wait to those who act early. From those who trust narratives to those who watch actions. Smart money sees the math and moves quietly. That's what institutions like Goldman are doing now, repositioning in Stage 1 before panic. For you, this hits home. Mortgage rates explode. Home prices fall. Bond-heavy retirement accounts collapse. Jobs vanish as credit dries up. Inflation crushes purchasing power. And once the crisis is obvious, exit's close. Preparation is only possible before the panic, not during it. So what do? Awareness only matters if it leads to action. Here are practical moves you can make now. First, reduce long-term bond exposure. Long-duration bonds are hit hardest when rates rise. Shift towards short-term bonds or money markets. This isn't about chasing yield, it's about preserving capital. Second, build cash reserves. 3 to 6 months of expenses minimum. Yes, inflation erodes cash, but cash gives you options. In a crisis, liquidity is power. When assets are dumped in panic, cash lets you buy. Third, consider hard assets. Real estate with strong fundamentals, productive land, essential commodities, and gold or silver. They don't default. They can't be printed. They've survived every currency collapse in history. Fourth, lock in fixed-rate debt and eliminate high-interest liabilities. In crises, credit disappears. Survivors are those who don't need to borrow when everyone else is desperate. Fifth, diversify income. One job, one industry, one country is fragile. Build multiple income streams so one failure doesn't take you out. Finally, stay informed, but don't panic. This isn't about getting rich from collapse. It's about surviving intact so you can seize opportunities on the other side. Because wealth isn't destroyed in crises, it's transferred. And preparation decides who receives it.